Have you heard that the dividend aristocrats are a good investing option to protect your money in volatile markets?
Or that they're a way to receive steady dividends even when the market is going down?
They have been stable in the past, but are those companies still a safe investment now when tons of companies are either cutting or suspending their dividends in 2020?
Well, today we're going to tell you all about the special nature of the dividend aristocrat companies, what happens if a company falls off the list, and how it can impact you and your money along with your investing portfolio.
Hi, I'm Nadia.
And I'm Nicole.
We're financially independent twins that have made it our mission to teach others how to master every aspect of their money.
We make easy to understand investing and personal finance videos on a weekly basis with the goal of teaching you how to become financially free.
So if that sounds good to you, make sure you hit the subscribe and the like button to join our community. Now, let's get into these dividend aristocrats.
Yes, so what exactly are dividend aristocrats and what makes them so special?
Well, Nicole, the dividend aristocrats are S&P 500 companies that have increased their dividends for at least the last 25 years in a row.
Whoa, you said 25 years?
In a row.
Woo!
Right? S&P started the list back in 2005, and ever since then, these companies have been tracked. They have almost always outperformed the rest of the companies on the S&P 500 while offering less of a risk.
Woo. Now, to become a dividend aristocrat, the company has to meet 4 requirements.
4.
Yes. 1, they have to be a member of the S&P 500. That's a given, right?
Okay.
2, they have to have increased their dividend every year for at least the last 25 consecutive years.
It's at least, okay? They also, number 3, have to have a capitalization of at least $3 billion. And 4, average at least $5 million in daily share trading value for the last 3 months.
That's a whole lot of money and a whole lot of trading.
Yep.
Now, there are currently 65 companies listed as dividend aristocrats, and they span across all the 11 different market sectors.
Yeah, most of them are in industrial or consumer staple businesses that we already know, like 3M, that's the company that makes Post-its, and Target.
Yeah, I use both of them, and I go to both of them. I go to Target a lot. So,
Yeah.
so the list is reviewed every year, and if a company gets kicked off, it's a big problem.
Oh man, something's funny with the money if they're getting kicked off.
Now, the main ways that a company can get kicked off the list is one of a few ways. 1, if they fail to increase their dividend, or if they're removed from the S&P 500 for any other reason.
That's
right?
not good.
Or they are acquired by another company.
Yeah, if this happens, the company is dropped from the dividend aristocrats list the first business day of the following month.
Now, you might be saying to yourself, well, this list seems to be pretty stable. Then what is the big deal?
Yeah. So, well, it's because during a recession, companies have a higher chance of losing their dividend aristocrat status, right? And actually, during the last recession, 19 companies fell off of the list.
Mm-hmm. We are currently in a recession, and if the pandemic isn't handled, we can be in a very long recession.
That's true.
On top of that, many dividend companies are having a tough time and have cut or suspended their dividend.
Yep.
Companies such as Wells Fargo and The Gap.
And there's a lot more. We just didn't list them here, all right? As crazy as it sounds, so far in 2020, 9 companies have actually been added to the dividend aristocrats list this year.
But you know, like we do, 2020 isn't playing any games.
No, 2020 isn't.
Yep. And while there's still times, things can go south real quick.
Yeah, knowing this information and the fact that it's taken longer than expected to handle this pandemic and get us out to the recession, we can assume that maybe a few on the dividend aristocrats list will fall off.
Now, really, question for you guys. Do you think most of the dividend aristocrats will continue to do well and increase their dividends regardless of this recession?
Okay.
If so, why?
Yeah. Now, if you assume that companies will fall off of the dividend aristocrats list, then what will be the consequences for the company and for those of us who own them?
Well, truthfully, it can happen. And what's good news is that S&P has already thought about this type of scenario, and they put some procedures and rules in place, right? Now, when it comes to your investments, the first rule is that the dividend aristocrats list can never go below 40 companies.
Okay, that's good.
Right? If at any time there are fewer than 40 companies that meet the requirements, S&P will begin adding companies that have met most requirements that we mentioned before, But instead of having 25 years of increasing dividends, they can have at least 20 years.
Okay, that sounds good. All right. Additionally, the S&P will not allow a single sector to dominate the index. If any sector is worth more than 30% of the index, S&P will start adding stocks outside of that particular industry with at least 20 years of dividend growth into the index.
So what does that mean? For those of you that hold Dividend Aristocrat ETFs, you should be fine, okay? It means that your diversification should still be there, but your risk might go up an insy-bitsy,
because they'll be replacing companies.
Exactly, and you're having less companies to deal with.
Now, if you own these companies in individual stocks, well, then you have to do what you've always done. Keep monitoring them, right? See if they still fit your personal criteria for stocks that belong in your portfolio.
I would even go even further with that. I would say you need to ask yourself some questions. Do you believe that the company going forward, is it going to improve and they're just being affected by, this recession and having a bad patch and they're still worth holding on in the long run? Or maybe things have changed for you, right? In the end, it really is up to you. If you are investing in individual stocks, you already know it's riskier. And it requires, like Nadia said, more monitoring and more decision making. And you also need to be rebalancing your holdings.
You should rebalance your holdings, especially now, okay? Honestly, if a company falls off the list, it would not be a good look for them and will most likely negatively impact their stock price. If the reason why they were kicked off was because they didn't increase their dividend or actually cut their dividend, that would be a sign that there's something up with their earnings.
A decrease in earnings could signal a larger problem within the company. Or it could be temporarily if that company is just going through a tough time, like we said, because of this recession due to COVID.
They might suspend it, not cut it, if that's the case. But you still have to wonder, what is different about this recession that they aren't able to keep up the business as smoothly as they were before when they did it through the last two recessions or before? It's been 25 years.
I mean, you got to remember, these are dividend aristocrats, right? These are companies that have been able to increase their dividends for the last 25 years. That means they're doing it between recessions. And if they were able to do it before, what's going on that they can't do it now?
If the reason that the company's earnings are going down are directly linked to COVID, and when the pandemic is over, they will be able to go back to business as usual, it might be a company that you think about holding, and it might be one you think about buying because they might be selling it at a discount.
That's right. Catch that good company at a discount. That's what we like.
I love those.
Yep. Now, if you would like to learn more about some of the strategies and why we came up with these ideas on, how to buy things at a discount and our thought process when it comes to, buying dividend companies, you should definitely check out our video called Great Investing Strategies for Passive Income.
And regardless of our assumptions, we have to acknowledge that the dividend aristocrats are a special bunch of companies, even if they may fall victim to the recession, right? These companies are leaders in their respective industries. They have long track records for dividend growth and strong cash flows.
And as a group, they have proven to be less volatile than the market as a whole during market downturns and recessions.
If you would like to learn more about some of these ETFs that we were talking about that focus on dividend aristocrats, check out our Royal Dividend video that we had put up before.
It has a great thumbnail. Nadia made it before. Now, if you would like to go deeper into why dividends are important and why we think they're great, check out our dividend investing playlist, which you can select at the end of this video.
And if you found value in this video, please show us some love and hit that like button, subscribe, and share with the people you care about.
That's right. And until then, see you in the next video.